Now, in this example, I want to show how we can compute the bond's price, and I want to use this example to show exactly the difference between the coupon rate and the market rate of interest. Now, this is the example from slide number 5 and number 6. Suppose we have a bond. The bond has a maturity 10 years, so it has 10 years left until the due date. Now, on the bond contract, the company states it's going to pay 13% coupon rate. Now, suppose this bond makes annual payment. In other words, the company makes one coupon payment per year. So annual coupon payment, 13% is the annual rate. Now, suppose we want to find the price of the bond. So we need to know what is the current market rate of interest. In other words, if we buy the bond, how fast, based on the current economic condition, how fast would our money grow? Now, suppose we find out it is 10%. So at the current time, the money should grow at 10%. Now, what's the price? First, we create a timeline. So this is the timeline. It has 10 years. Now, because the bond makes annual payment, each year is a period. So there is one payment per year. So we have 10 periods. 10 periods. Now, at the end of each year, each period, the company, as promised, will pay 13% of the par value. Now, the par value by convention, corporate bonds have $1,000 par value. So each year, the company will pay $130, and this number is constant. So coupon rate is always constant. The coupon payment will be constant. So there will be 10 coupon payments. Now, at the end of the bond's life, whoever holding this contract will can surrender the contract and will receive $1,000 par value. So this is the last payment. Now, we want to invest in the bond, so we need to know the price. Now, imagine if we pay the price, so our money is invested in a bond. Based on the current economic condition, the money is going to grow at 10%. So this is the growth rate of money, is the yield for 10 years. Now, we want to know what's the price. Now, of course, the price should be the now, if you think about this investment, we are doing one thing. That is, we give up the current price, and in exchange, we want to receive the 10 coupon payments plus the $1,000 at the end. So, this current amount should be equal to the future amounts, meaning the value here should be the present value of all the future payments using this growth rate. So the principle of bond valuation is that the price of the bond is the present value of all the future payments discounted using the current growth rate of money, the market rate of interest. We have two groups of cash flows. First group, coupon payments. The coupon payments, 10 coupon payments, they are equal. So the coupon payments are level cash flow stream, annuity. So we can use annuity PV formula to compute the present value of this part. We also have this one last 1,000 face value payment. It's a single cash flow. So we use a single cash flow PV formula to compute this one. And we add the present values of these two parts together. We get the current price. Now, the formula looks like this one. So this is the formula. As you can see, the C represents the constant coupon payment. Now the coupon rate is used to compute C here. For example, we use 13% to get 130 here. Now the payments must be valuated at the current gross rate of money, 10%. So the market rate of interest is used as the discount rate. So this part is the annuity PV formula. We have the face value, this $1,000 at the end of the bond's life. Its present value is computed in this way. So the price of the bond is the sum of these two parts. Of course, we can use Excel to compute the value. Now, using Excel, still we consider the 5 elements. PV is the beginning investment, the one we want to solve. So this is the PV. I put a question mark because we want to know this part. The investment is going to last for 10 periods. So this is the MPER. So the second element, MPER, number of periods, is 10. Now, the growth rate of money, the rate is 10%. So our money is going to grow at 10% over the bond's life, the third element. Now, the bond will bring in intermediate payments, 10 of them in the amount of 130. So that's the payment, the fourth element. Now, at the end of the bond's life, after the company pays all the interests, the company still owes $1,000 to the bond owner. So this is the ending balance, $1,000 ending balance. So we have 5 elements, PV, MPER, we have the rate, we have the payment, and we have the ending balance. Now, if we know 4 of them, we can find the 5th one. For example, in this example, if we summarize the 5 elements, we have MPER, which is 10, the rate 10%, payment 130, ending balance future value 1,000. The only element we don't know is the PV, so we are going to use the PV function, Excel PV function. Now, if you use the Excel PV function, now the syntax is the PV, so equal PV. The first element is the rate, so that is the 10% rate. Second element is the MPER, 10 periods. Now I have the coupon payment 130, face value 1,000. So this is the Excel syntax. It should give you the result, which is negative $1,184.34. This is a negative number. It means we have to pay $1,184.34. It's outflow. So that's how we compute that's the basics of the bond valuation.